Hi, Jeff. Welcome. Welcome to Malaysia. It's your first time here, right?
Yes, it is.
And thank you
Excited to be
very
here.
much. Yeah. Sorry about the weather, but rain is good.
I like it. It's exciting.
It builds trees,
Yeah.
right? Like acorns to mighty oaks.
We need it in California.
Yes. But anyhow, fantastic presentation, very enlightening. And there's so many questions that I'm sure a lot of people will ask. We just have 30 minutes. But let's just talk about the app first. I mean, I just want to understand more. It's simple, easy to use, yet it's very powerful in a sense that it tries to connect or tie two very opposing concepts, which is spending. If you spend, you don't really have much money to invest. So what it does, if I understand that correctly, is that whenever an investor or a user starts to buy something, you actually nudge them to invest the spare change into a portfolio of ETFs.
Yep.
Okay. So in a sense, it's not really changing your lifestyle, but it's actually inculcating some sort of investment behavior in your daily lives. So when you first launched the product back in 2014, it looks simple. It's an app, right? But people don't see the intricacies that have to be executed well to ensure each component of your entire value chain can work and function efficiently and seamlessly. It's because I mean, in my line of work, there's a lot of people who are inspired by your app, but they fail to realize that it's not just an app. It is an app which is a gateway to a whole host of investment platforms and all that. So when you started thinking about this product from conception stage until the actual rollout, what were the building blocks that need to be in place?
Yeah, so the infrastructure is, I think, a part of the business that doesn't get as much attention. And I spoke a little bit about building the self-clearing broker-dealer, the investment advisor aspects of it, building actually the trading platforms, carrying these individual accounts economically required us to have a system that effectively had no commissions, of course, because if we're handling billions of trades a year, and we would pay more in commissions than we'd manage in assets. And beyond that, actually, maintaining regulatory compliance and owning that side requires us to really build powerful technology that no one sees on the compliance side. And Eli and I often talk about how a lot of the technology we build is really sort of compliance technology, because to scale that side of the business, to approve 10,000 accounts a day, if not significantly more, you need to automate certain parts of it and really understand how your business is designed from the ground up, and that includes the types of products that you offer, the types of investments that people buy, making sure that you can aggregate those effectively into larger orders so that you can actually reduce the cost on trading. You have to make sure that you can open lots of accounts, meaning that you have to get the right information from people, verify their identity properly, make sure that the funding source is valid. And you have to make sure that you're proactive in communication, because if there are issues in the market and you're dealing with first-time investors and you have a million people call you with a team of a few hundred, the math doesn't work there. And so you have to think of those things ahead of time. And so the infrastructure we built is significant, and most of the technology that we built isn't seen on the customer side. It's seen on the company side. And a lot of it's about scale. I mean, we could build some things that were interesting experiences that maybe a one-off product that one or two people could use, but to manage thousands, tens of thousands, or millions of accounts, we had to build really significant infrastructure. And building infrastructure is a huge opportunity in fintech. And actually, the second company started, Say, was really building on that and looking at proxy distribution, proxy processing, because one of the requirements for us is to handle these communications, or at least have a partner that can do it for us. And And that's another thing that doesn't seem particularly sexy, handling proxy voting. So rebranding that as shareholder voting is, I think, a bit better. And that's connected to what we've been doing at the Treasury, building that out. It's about building infrastructure and not being afraid to build out regulated sides of the business, going for a license, meeting with regulators, because that rigor is incredibly useful when you're building a new company. I mentioned in the talk yesterday that getting asked tough questions by investors is useful when you're building your company, or asked by tough questions from people you want to hire. And we're not afraid to invest or back companies that are looking to get a license. In fact, we're sort of big fans of investing in broker-dealers, sort of explicitly regulated businesses, because building that real aspect actually often leads to better technology. Fintech is an area where if the entrepreneurs don't dive in and really read the rules and understand what they're building, I think they'll struggle to build really transformative technology. I think there might be some interesting features, but I think the business will both be dependent on a partnership for customers that actually have their account custodied somewhere. And I also think there's a limitation on understanding how to really guide them through a fantastic customer experience.
So it's a fintech company. So how do you get the fin and the tech in the right kind of balance? Because, what you said about building the infrastructure, technology is very key. But when do you start actually meeting the regulators? Because at the end of the day, you're actually offering investment opportunities, right? Yeah. So how do you get the timing right as to when you actually start negotiating or talking to the regulators, when you are actually building the infrastructure? Because if it's something that is before its time, then you might actually waste your resources in building something that will never be approved. So how do you strike that balance? Great
question. And it's funny, fintech wasn't really a word when we started the business. And not too long, or a few years in, I was asked, why'd you start a millennial fintech company? And millennial wasn't a word that we really used either. And I was horrified when I heard that. So yeah, the fin in fintech is significant and the most interesting part in many ways. Finance, and I mentioned this yesterday, has a really rich and fascinating history and has transformed the world for the better in many ways. And recently in the U.S. it's sometimes become trendy to bash on finance, and there may have been some large banks that have made decisions that cost people some money and have been not necessarily always positive. But over the long term, finance has transformed a lot of many aspects of our lives that we may not necessarily directly connect to finance or banking, which a lot of people sort of use as a placeholder for finance. And so that's why I think fintech has such an opportunity for continued growth. I mean, most of the great fintech companies haven't been started yet, and I think for ideas and opportunities to look at history is probably one of the greatest places to start. And it's okay to work on a problem that's not necessarily a new problem, or to be inspired by solutions that aren't necessarily new solutions. If you take some of the lessons from the stock certificate and the shareholder meeting and really get to the heart of what ownership is about, you can translate those into digital products and experiences that are more scalable. And I think technology is very helpful with scale today. And one of the reasons why technology companies can grow quickly and raise a lot of money and leverage venture capital effectively is because they're able to use technology to scale. And so opening a broker-dealer is and building a regulated entity is a big undertaking. And to answer your question, working with the regulator early is essential. Being proactive on that is important because it's going to take time for people to get comfortable with it, especially when you have scale. Because most broker-dealers in the United States have less than a few hundred customers, let alone a few thousand or tens of thousands or hundreds of thousands or millions. And so understanding how the product connects to scale. Understanding how compliance can scale is essential. And so for us, we met with the regulators long before we dropped off our application. And I remember the first thing they said was, this better not be crowdfunding. And it wasn't. But it was very helpful for us. We were asked a lot of hard questions, and we had to build out a lot of the systems and books and records and everything else. And they like to see their feedback incorporated into us building our product, and that makes sense. Them making sure that they know they're heard is important, especially when you have a lot of tech companies that are just sort of moving fast and breaking things. It creates a lot of anxiety sometimes. And so I think when it became clear that the bulk of our technology was really related to regulatory compliance and protecting our customers, helping them, I think they started to get excited that we were increasing the base of investors, which ultimately is great for everybody.
It's great. Did the product pivot much from it was first conceived? I mean, do you have to have a lot of adjustments along the way because there are so many partnerships that need to be made? At the first point, you didn't really have your own broker-dealer, right?
Yeah.
Because you actually acquired the license later on.
Yeah, we applied for the license.
And how hard was it to convince someone to partner with you without destroying the ethos of your company?
Extremely hard. I think in some ways we maybe overly emphasized partnerships in the beginning. It's tempting an early stage company to think about partners as entities or people that will build the hard parts of the business. And I think that's a very bad way to approach things sometimes. There may be a very hard part of the business that you can leverage a partner to handle, but if you have no hard parts of your business that you're building and tackling, then your business may not be that defendable or worth building. And it's also difficult to maintain control of your own destiny as a company if your partner is the decision maker on carrying individual accounts and everything else. And so the first key partner was the sort of clearing firm, banking partners, some of the firms that we're required to work with, even on an omnibus basis. And getting them to believe in us, was important, and we made some great friends at RBC that were helpful to take a risk on us, in U.S. Bank as well. And there was a bit of a chicken and egg. The regulator wants to see the partnerships, the partners want to see the regulatory approval. But when you put the product in people's hands and you share the mission, it's helpful. And having a mission-driven company, to create investors to support the financial best interest of the up and coming is something that people can get behind. And so when you're asking someone to take a risk, if you're doing it for good, people are more likely to sign on.
Great. So now let's talk about your customers, because you built this to serve them, to serve users who have been underserved, who has not really had the opportunity to even think about investing. So first of all, what was the experience like in terms of marketing your new service to the investors? I mean, is there a silver bullet marketing channel out there, or how you said when you first launched you had people lining up, queuing up.
Yeah.
How did that happen?
So there are a few things going for us. So I mentioned earlier that branding the company as an app and launching it as an app. If you're a new brand and an app, I think there's more excitement and interest and curiosity in what you're doing. And I think a clear recognition that what you're doing is new. It may not exist before, because there's that expectation that a new app, new company is doing something interesting. So that part helps. Next is people that invest, especially for the first time, they like to talk about it. So making sure that we could help our customers talk about investing with us, with their friends, that they could show it to them. It's quite helpful. And next to that is, when you connect investing with spending, you create all of these moments when people paying for dinner, people buying something, where they can talk about Acorns as well. So every time people were paying for dinner, oftentimes we found that the people that were using Acorns wanted to talk about it, and we got these anecdotes from our customers. We also felt it ourselves, and so people were explaining to their friends, coworkers, to their barista, that they were rounding up these transactions. And so the word of mouth is sort of the first aspect of it, and making sure our product can support people talking and sharing about investing with us. And then next to that, making sure that we could scale our paid acquisition. And so we used Facebook extensively initially, mobile installs, and to really distribute investments like an app, and not like traditional financial services, required us to build an app. So the fact that we designed Acorns as an app, as a new company, like an app, allowed us to leverage that type of marketing effectively. And our cost to acquire customers are orders of magnitude below the incumbents, and allowed us to scale paid acquisition in a way that hadn't really been seen before. And so I think it's important for startups to understand how paid acquisition scales, because if you want to raise a round of funding or a significant round of funding, you really need to have a firm grip on how your cost to acquire customers can grow and scale. So we're quite proud of how that aspect works, and it's you want to tell compelling stories. You want to help people realize that something like investing is within reach. You also need to make sure it's not too heavy. If someone sees this in their news feed, and you message something around retirement, you're like, hey, have you thought about retirement? And like the thing before is like a joke from a friend in a meme. Like that's pretty heavy. But if it's investing spare change, that's an app-appropriate decision. And then once people start investing, by the time they finish registration, they're ready to make a more significant investment. And so it has to be the right segue from what people are consuming.
Do you track, your first early investors as to how they've grown, or do you have any stories to tell, whether they've stayed with Acorns now, or have they
gone to
Betterment when their AUM gets bigger? So how is the reaction, or how's your customers' development like in terms of investing with Acorns?
Yeah, so what's fascinating is when people start investing spare change, people have been excited to even put together money they didn't think they could put together. So there's that excitement that, hey, I've never been able to save $50 or $100, and I just did that. And then they see it compound, and the market fluctuates. Some people, they add $100, they take out $50, and they add $10,000. Right. And so there's a lot of kicking of the tires to sort of vet the product initially. People want to see, is it easy to get my money out? I feel more comfortable putting it in, if that's the case. And we also refine how we message and communicate the product. And so we want to make sure that we're supporting our customers investing the right amount of money. If we ask people to invest too much and they decide to pull it out, we don't really have many second chances from that. But if they're automatically adding money, then we sort of build that back up. And so we found that people have saved on average, in excess of 500 to 1,000 plus a year with Acorns. People that haven't really saved that much before. Some of those accounts now that we're many years in have grown significantly, and not making promises on the investment side, but just on the savings side, it's pretty substantial. And so when we talk to our customers, we listen to them on what they'd like to see added to the product. And another wonderful thing about an app and launching a company designed around an app is people expect their app to update. So that means they expect your company to launch new products. That is a great position to be in when you're launching new products. And so that expectation from the customer allows us to launch and innovate and evolve the app. And we moved into a product called Found Money, where we work with partners and retailers to find our customers' money, sort of converting cashback rewards into invest back, to leverage the interesting aspects of investing, so that investments are long-term and aspirational, things that brands would like to connect with. We moved into offering retirement accounts, which are fantastic for retention as well, and longer-term thinking. And then we also moved into spend, not launching our own debit card. what we found is that the people that had connected Acorns to their accounts, they tended to use the card that was connected to Acorns more than their other cards. And it was effectively a self-funded rewards program in many ways. And so we were able to design our own card to offer, enhanced rewards and a better experience. And that's resonated with our customers.
You talked about all the other products that have evolved to suit the needs of your investors. How about there's this new product called Boost or multipliers? What's that all about?
Boosting?
Yeah, boosting.
So you can multiply your roundups, basically. Not too long after we launched, people said, "Hey, I love roundups, but I'd like to invest twice, the amount of my roundups, or 5 times, or 10 times." And it's interesting, there's this curiosity around roundups, which is, people don't necessarily know how much they're going to invest. They feel comfortable parting with it. And we wanted to play off that thinking. And we get asked sometimes, like, well, why don't you just have people invest $50 a month or $100 a month? Just automate that. It's just more streamlined. And we do that too, but people are interesting, and people think about things not necessarily so rationally. And so when you want to get someone to make a decision like investing, if you can connect it with spare change and roundups, it seems efficient when they're sort of visualizing their spending, or they're thinking about their sort of piggy bank where they put their coins. And so, yeah, that's where we have the boost and multipliers. It's the first time I've ever been asked about that, so I love it.
Because people tend to think, oh, this is great, spare change, but how can you really grow your wealth? I mean, it's just spare change, will take a while. People think, is this a gimmick? Can they really grow your wealth? But you have all the other products inbuilt as well. So it kind of, the journey of the customer grows with the journey of Acorns in a way.
Of course. Yeah, and as a startup, one of the exciting parts of being a new company is we grow with our customers. And the customers that are early customers are eager to hear our story. And so as we grow and offer new products or raise money, there's a lot of enthusiasm and pride from customers that have been there since the beginning. And on the investment side, is it meaningful to invest spare change? Well, starting small is the best way to start. And I think that if there are big promises, sort of making really big decisions, then people should be wary. Good investing takes time, and people should focus on returns on average over the long run. And we feel confident that if our customers invest regularly in a diversified portfolio over the long run, they will do quite well.
Yeah, I mean, that's an interesting thought, because can you just imagine someone who does have no idea about investing? If you give them 50,000, they don't really know where to put the money. They'll start making bets, right, in the stock market. So by just allowing new investors little money to invest, at least they learn there is the financial literacy bit that you offer as well. And as they grow their portfolio, they become better at investing, and probably that's the best way to go forward for first-time investors. Okay, this is probably the most $1 million question, but maybe not. Your target investors are new investors, right? And you are one of the largest growing robo-advisors because from the number of clients that you've acquired, more than 5 million, maybe it's reaching 6 million. But compared to the other robo-advisors, the AUM, or the size of the average account, is much smaller. Yeah. Right? So how do you really make money or compete with say, Betterment, who has AUM per investor, which is much bigger compared to, as you say, 500 per investor? So where does your main revenue come from, and how do you stay competitive?
Great question. So we take a long-term approach. We think about it, if you were to create a product out there that could train millions of investors, that by the time they're 30, they've been investing for 10 years and building wealth and sort of experiencing market fluctuations and downturns and upturns, we think that guiding our customers through that is incredibly valuable, and our customers become more valuable over time. Now, the way we make money is quite clear too. We charge $1 per month. Now, if you're a student and have a very small account, we make it free. But we also think that people value what they pay for. And we also make it clear in the app, if you invest $1, that's not the way to use Acorns. The goal is to add money regularly. And so if you invest $1 million with us, we still charge $1 per month. And then if you want to have a retirement account with us, that's another $1 per month. And if you want to use the debit card, that's another $1. So the max you pay is $3 per month for that, which we think is quite a good deal. But we also think that successfully guiding our customers, or the up and coming, the future, wealthy in many ways, is a great place to be. And it's on us to keep those customers. But we think that we're doing a pretty good job of educating them through the journey, of making sure that they pay attention to the right things, and also making sure that we evolve the app and experience so that they can access deeper rights associated with investing, including voting your shares and including a closer connection to the companies you own.
Okay, so we're running out of time. Actually, some of the questions I've actually asked for the audience. Okay. But the top ranking question is, when will Acorns enter the Malaysian market?
Well, I can't comment on that, but we do have partners that we've started with at Acorns. Raise is one of them. We launched Acorns Australia initially, which was rebranded as Raise. And what was exciting about that is, for us, we found a fantastic partner that was so excited about what we were building that it probably would have been harder to not partner with them to launch. And I think when you think about international expansion, partnering with the most enthusiastic teams locally is important, because that's the energy and focus that it takes to really make it successful. And so it's not really about Acorns like looking to say we're going to go here or here. It's about listening and partnering.
Okay, that's great. And one last question from me.
Yeah.
What keeps you motivated and what keeps you awake at night?
It's incredibly inspiring to help someone become an investor for the first time. When I became an investor, I had a million questions for my dad, and what we're finding for our customers, they're excited and motivated, and people tend to look at their life a bit differently when they see themselves as an investor, as worthy of investing, and it's a responsibility to serve that and to stoke that excitement. If your customers are excited about doing things that are good for them financially, then it's a real opportunity to stoke that and to build on it. And so that keeps me excited. And the other part is working with entrepreneurs and founders. Fintech begets fintech. And Eli touched on it a bit, but the fintech community in the U.S. Was pretty small not too long ago. And it's really grown quite a bit. And working with other founders is essential in terms of when we're building our companies. We both relied on advice from a ton of brilliant founders and advisors and others. And so working with other fintech founders is one of the most exciting parts of the business, because they're thinking of things I've never thought of. They're tackling problems that seemed impossible for us, or things that we should have built out. And oftentimes it's like, what, that should exist. I wish we would have built that. And it's great for the customers ultimately.
Thank you very much, Jeff. It was really a very exciting session
to
have you here. Thank you.
Thank you.